Okay, so I was skimming the internet the other day and I came across this really unsettling article by Thomas Yeung, where he argues that there are hidden signs that the next great housing collapse is imminent, and it's going to start in a very unexpected place, with fintechs. Yeung is a Princeton-educated CFA and investment analyst who writes for Investor Place, and he says hidden leverage in the housing market could be acting as a ticking time bomb that threatens housing prices nationwide. And when it goes off, it could bring down not just the housing market, but a good chunk of the fintech market with it, which is not great news if you're a spelling challenged YouTuber who's heavily invested in fintechs, or anyone who owns a home or is exposed to the stock market in any way. Now, I'm not one to take everything that I read on the internet at face value, but after looking deeper into Yeung's argument, what stood out to me is how a seeming random collection of fintech companies may be putting the entire housing market at risk of entering a negative feedback loop that eventually ends up crashing the entire market. And it wouldn't be the first time over-leveraged sellers crash a market. So hey everyone, and welcome to FinTech. And in this video, I'm going to break down what exactly has Yeung so worried about fintechs in real estate, going over some of the warning signs we're already seeing out of companies like Rocket Mortgage and Opendoor, how the fallout of this could end up crashing both the fintech and housing market, and finally, I'll go over what you can do to protect yourself if we do see another 2008 style housing crash that hits fintech stocks just as hard. Now, many remember the Great Recession of 2008 as being kicked off by a single event, the collapse of the investment megabank Lehman Brothers, where one of the biggest banks in the world invested heavily into mortgage-backed securities propped up by a bubble in the US housing market. This made them tons of money at first, but when that bubble eventually burst, Lehman's losses became insurmountable, sending the company with over $600 billion in assets into bankruptcy in a matter of days. It was the largest bankruptcy in history. And now many today are worried that we're seeing the same thing playing out at Credit Suisse, which boasts over $750 billion in assets, more than enough to shake up economic markets worldwide if they were to go under. After the European bank's CEO released a memo attempting to reassure its staff about the strength of their business, it accidentally ended up kicking off a panic in the market, with the bank's stock price declining 12% in a single day amid rampant speculation that the firm was on the verge of bankruptcy. This led many amateur analysts on social media to begin comparing Credit Suisse to Lehman Brothers in the years leading up to its demise. But while there's no denying the economy is in a precarious situation right now, with the Fed trying to curb high inflation without tipping us deeper into an economic recession, Yeung points out that the internet is looking for a crash in the wrong place. Credit Suisse might be a mismanaged bank with a seeming inability to stop swapping out executive team members, but they are actually less highly leveraged today than they were back in 2011, showing that they might be losing market share, but they probably won't crash spectacularly like Lehman Brothers did, even though you know the clickbait is tempting. But that doesn't mean the next Lehman Brothers style collapse isn't out there. We just need to look a little bit deeper to find it. And Yeung thinks the next housing collapse will have its origins in the hidden world of fintechs. While you might not think of fintech companies as having the same power and impact as large investment banks on Wall Street, the number and influence of fintechs has been growing exponentially in recent years. Since 2019, we've seen a near doubling in the total number of fintechs operating in the US to over 10,000 today. There are now more fintech companies than there are pandas in the wild, which apparently is because pandas forgot how to procreate, or maybe they just know they don't need to settle. You do you, single pandas. But these aren't your father's fintechs. Some of them have hit an absolutely massive size. Rocket Mortgage is a famous web-based mortgage provider, and it's now the single largest originator of home mortgages in the country. WeWork is now the single largest office tenant in New York City, Chicago, and Boston. And while you might not consider an office hoteling app like WeWork to be a fintech, Yeung points out how they basically act like an office retail bank, taking on long-term leases in buildings and then renting them out to individual workers on a short-term basis. But as the influence of fintechs has grown, it's also started to expose the massive risk behind many of their businesses. Rocket Mortgage currently has a debt-to-equity ratio of 26.6, which is worse than 99% of banks according to Guru Focus. For comparison, if I buy a house with a 20% down payment, I have 1/5 the value of the house as equity and 4/5 of the value as debt, giving me a debt-to-equity ratio of 4 to 1. But I sure wish I could own $1 million house for less than a $40,000 $30,000 down payment like them, maybe then I wouldn't have to sit in my freezing office / recording studio / lunch table. But there's also a reason that I can't get a loan like that. It would be super risky. Rocket Mortgage's high debt ratio is because they hold on to their mortgage contracts longer than a traditional bank does, which makes them more money when times are good, but also exposes them to massive downside risk if the housing market takes an even slightly negative turn. Basically, right now, a 3.8% drop in the market would be enough to completely wipe out Rocket Mortgage's equity position. If we look at an average real estate investment trust, or REIT as a comparison, which is just a company that buys real estate in bulk so that you can invest in it, Yeung points out that the average REIT has a debt to equity ratio closer to 6x. So comparing Rocket Mortgage's 26.6x to that ratio really shows the risk Rocket Mortgage is taking on, and the impact of that risk could be a lot higher than anyone is predicting. But one way to make money even in a declining market is to carefully pick winning stock investments, which is a lot easier to do with the right investing platform. This video's sponsor, Moomoo, is a commission-free trading platform that makes it easy for traders to do everything they need, from charting and trading stocks to connecting with other traders to investing in ETFs or options. Now, when you sign up for Moomoo, you can get up to 15 free stocks, and using my exclusive link below, when you deposit even $1, you can get an extra $10 coupon for a limited time. Moomoo is owned by Futu, a Nasdaq-listed fintech that's been in the industry for 10 years with over 19 million users. Moomoo enables active traders to trade like a pro with professional-grade tools, but with an easy-to-understand consumer-level interface. They can help you monitor market movements, perform deep technical analysis, quickly screen for stocks that meet a set of criteria, and they provide a community for you to bounce ideas off of. One interesting feature is the ability to paper trade stocks. You can sign up for a paper trading account to practice investing without putting real money on the line, maybe by taking one of Moomoo's investing courses or by learning from others on the app. Or you can use Moomoo's heat map to see at a glance how the market is performing. Moomoo is the most advanced free trading app that integrates AI-powered tools, comprehensive real-time data, and an engaged investing community all in the same app. One of my favorite features is the ability to track institutional investors. So if I open up the Markets tab and scroll down, I can see institutional investors such as Warren Buffett's Berkshire Hathaway. In it, I can see the industries that they are investing in by percentage, scroll down to see individual stocks, and of course, click into the companies to see even more details there. And right now, Moomoo is offering the chance to win up to 15 free stocks when you deposit $2,000 with them for at least 60 days. And by using my exclusive link below, when you deposit $1, you can get an extra $10 coupon for a limited time. So check out Moomoo using the link below, and let's get back to fintechs and the housing market. Here's a way to understand exactly how much risk fintechs like Rocket Mortgage are taking on, and how likely they are to accidentally crash the market. If I buy a house for $100,000, I know probably not going to happen, but if I found a place for $100,000 and put 25% down, that means I have $25,000 in equity in the house and $75,000 in debt. So theoretically, I can sell the house for $100,000 and use that money to pay off the $75,000 in debt while still recouping my original $25,000. As long as the price doesn't go down, I don't lose any money. But now imagine the price of my property drops due to a housing crash. Now my house is only worth $75,000. Well, if I sell now, I need to use all $75,000 to cover my original debt, leaving me with no equity left over. And if the price declines any farther than that, I'll be underwater on my mortgage, since the house will be worth even less than the debt that I owe on it. Now, this is unlikely to happen with 25% down, but that's not very highly leveraged. In Rocket Mortgage's case, any major decline in housing prices could set them up to where they just have to sell to keep making debt payments, which in turn could drive housing prices even lower, making them sell even more, in a negative feedback loop that could spiral into them failing just like Lehman Brothers did back in 2008. But nothing to worry about, right? That would require a nationwide drop in housing values, and we would definitely see warning signs of that coming before it actually hits. While housing prices as a whole have not yet started dropping, we are starting to see some very concerning signs out of other real estate-focused fintechs. Kind of how you know it'll be a bad day when you're at Chipotle and they only give a half scoop of chicken to the next person in line. Just me? Okay. Well, the warning signs in fintechs all start with iBuyers, only getting their half scoop of chicken. iBuyers are businesses that make instant offers on home purchases using statistical models and algorithms. So if I want to sell my home, I can go on an iBuyer website, enter my home's details, and the company will immediately make me an offer to buy my home. The largest iBuyer in the US today is Opendoor, who runs a portfolio of over $9.5 billion, operating in markets ranging from Atlanta to Austin, from Las Vegas to Miami. But a few weeks ago, Wired magazine wrote an article about Opendoor, pointing out some concerning stats behind their house buying. And why is this relevant? Well, because iBuyers buy so many homes at once, they basically act as a magnifying glass for the real estate market. Any tiny shift shows up in their numbers before it hits regular buyers and sellers. For example, Opendoor bought 155 homes every day in Q2 2022, so their behavior can be used as a leading indicator of where the housing market is headed, and things don't look too good. Some people may remember Zillow laying off thousands of employees at the beginning of 2022 after their own iBuying division began struggling to make money, eventually resulting in a $500 million write-off for Zillow. Opendoor, however, continued buying, claiming they are much less exposed to housing fluctuations than Zillow was. But even they are starting to run into issues. Bloomberg reported how Opendoor lost money on 42% of its August house flips, a sign that the company underestimated how much demand would slow. This also acts as a leading indicator for us, at least within the markets they work in. That housing market has slowed dramatically already and will continue in that direction for the foreseeable future, which is going to impact all areas of the economy and the stock market, and thus our everyday lives in ways you might not expect. So algorithmic firms like Opendoor or OfferPad are starting to lose the ability to flip houses profitably, which is made even more clear in the collapse in their stock prices. And that may just be the canary in the coal mine that tells us the entire housing market is starting to slow down and even decline. This is supported by data from real estate analytics firm CoreLogic, who showed home prices fell 0.7% from July to August, and prices of 10-year Rocket mortgage bonds are now trading for 60 cents on the dollar. And in some markets like Toronto or Long Island, prices are declining even more sharply. But okay, this might just be localized to a few areas of the country, and overall the market is only slowing a little. No big deal, right? But while it might not be a big deal on its own, if that decline is magnified enough by, say, I don't know, some over-leveraged real estate fintechs, that could be enough to kick off a negative feedback loop that eventually brings down the entire market. So we have a potentially declining housing market with a bunch of fintechs controlling significant leverage in that market. If prices decline too much, those companies will need to act fast to avoid falling into a feedback loop as they chase declining housing prices. So it's really going to fall on those companies' leadership to avert a crisis. But as Yeung points out, the leadership in those companies doesn't have a lot of experience in stagnating or even declining real estate markets. Opendoor's top executive team, just as an example, hails from quantitative trading and data analysis. None of them have experience in real estate investing. And this risk in fintechs isn't limited to just a few companies. Out of the top 5 most indebted US financial firms, 4 are non-banking mortgage servicers, including Rocket Mortgage, showing that there is a clear pattern of real estate fintechs specifically taking on more leverage than the norm. Here's a crazy stat. Those 4 firms control more than $80 billion in assets, but they collectively only have $2 billion in equity backing them up. That is a lot of leverage, which means any small market fluctuation will be massively magnified, like 40x. We see some areas of the market starting to recognize the risk of this giant pile of money being propped up by a tiny amount of equity. Opendoor's bonds have been steadily declining in value all year, with Reuters rating the company's credit as 1 out of 100, the worst score that they can give. This sets up the whole real estate fintech space like a giant house of cards. All we need is a large enough dip in real estate to send them all crashing down. So no one can say for sure what the housing market will do over the next year or even the next month, but there are analysts such as Ivy Zelman of Zelman and Associates predicting a 9% drop in home prices by 2024. Or Yeung himself, who estimates that a readjustment in housing values to bring them more in line with historical averages would result in a 20% drop in current prices. Now, I'm not saying that that's going to happen for sure. I'm not an expert in forecasting home prices, but here's what would happen to real estate fintechs if we did see see a 9% drop in home prices. First, companies like Rocket Mortgage would immediately find themselves underwater on their debts, and iBuyers like Opendoor would need to exit the market, similar to what Zillow did earlier this year. And if enough of these fintechs have to dump their assets all at the same time, it could result in flash crashes in several popular real estate markets, such as Phoenix, Arizona, and even spread to other parts of the nation. Any unfortunate home buyers and sellers during this time would likely be caught in the crossfire of the fintech meltdown, and investors in these companies would take on massive losses in their stock portfolios. But that's a worst case scenario, and things aren't all doom and gloom. As interest rates continue to rise, for example, Rocket Mortgage's risk actually decreases since their debt is worth less and less every month. That lessens their risk going forward. Plus, we've seen from Zillow's example that while offloading an entire home buying business is costly, it won't necessarily bankrupt the entire company. And if it's done carefully, it doesn't necessarily have to crash the housing market. So here's what I would do as both someone who owns real estate and a fintech investor. I would be careful about investing too heavily in the highly leveraged real estate fintechs, at least until we're sure that there won't be any large shocks to national home prices in 2023. I would also avoid relying on home prices continuing to increase in hot markets like Phoenix, and would instead focus on buying property at a reasonable price to either live in or rent out for a positive cash flow. I don't think speculating on home price is ever super safe, but it's doubly dangerous right now. And lastly, I wouldn't write off all fintechs, since there are many who actually benefit from rising interest rates without the same downside risk as companies like Opendoor or Rocket Mortgage. Yeung even calls out Charles Schwab and SoFi as two possible beneficiaries of rising rates, though full disclosure, I do invest in SoFi. I'll have a link to sign up for Moomoo below, and if you found this video valuable, maybe share it with a friend and subscribe, and I'll see you next time.